Joining us now is Brian Belski, Chief Investment Strategist at BMO Capital Markets. And Brian, they told me you were going to be on the phone, but it's good to actually see your face in person right now in front of a screen there. So welcome to the show. You've heard the investment committee today. There's a little bit of caution and skepticism brewing right now at these levels, given the sharp run that we've seen higher. But you think perhaps that there's more room to run.
You know, we do. Thanks a lot for having us, Mr. Chu. And, you know, we were on your program and your network on March 23rd and said the market was going to rally 40 to 50% from the lows. And then we were on this show the day after. They quoted me saying 324 that is Belski going to be right? I mean, I don't know. And then a week later on 3:30, we were on your network, same show, and said that the market was not going to retest. And we've received a lot of negative rhetoric from that. I mean, so why did we get to that conclusion? If you take a look at these bearish prognostications in terms of the forecast, these people that are looking for the Great Depression type of call, it's like calling for the final score of the game and not allowing the players or the teams to even be picked or play. They came up with that conclusion because they thought it was the most prudent and negative thing to do. Wall Street has been negative for the better part of the last 20 years, and we feed on this negativity, and we've forgotten that coming out of these types of events, which, oh, by the way, to us it's feeling more like a natural disaster than it is the Great Depression, and as such, that actually adds more fervor to the fundamental rally coming out of this. But by and large, we still believe that the U.S. stock market is the best place to be in an increasingly bad neighborhood. We think Canada is not too far behind, by the way. And the more bottoms up you can be, the better. Josh Brown had a great comment in the beginning of the broadcast talking about we're never going to see this again. So learn from it. Michael Farr came out and talked about how you have a bull and a bear. Someone's going to be right. We think as you move from despair to hope, we're in the best country in the world with the best stocks in the world, and those that were leading are going to continue to lead. But remember, post the tech wreck, people in our business said they would never buy another tech stock again. They'd never buy another tech stock again. In the next 20 years, what came out? Google, a rebranded Apple. Microsoft became a new company. Amazon became a power base. Netflix was a new company. We're going to have new leadership. And that's going to continue to base and plod the bull market. So we still think we're in a 20-year bull market.
Brian, okay, so I want to push back a bit here, and this is no disrespect to you. The names that you just reeled off right now as being from kind of emerging from that last kind of bubble bursting have been leadership in this stock market for arguably years. And mathematically, it's justified in a market cap weighted index like the S&P 500. There are those out there who say that they're the narrow leadership in the S&P because of just those mega cap tech and communication services names does not bode well for the better long-term trajectory of the broader market, because it is just about 7 to 10 companies that are driving the vast majority of these gains. How exactly then do you counter that argument that the leadership, meet the old boss, meet the new boss, same as the old boss, is what it comes down to? Is this going to be a market of just those 10 stocks again for the next quarter, 2, 3, or 5 years?
It's a great question. We actually published on this today because we've been getting so many questions. And if people actually did the analysis, they would see that this has happened before in the market. It happened in 1990. It happened in 1994, 97, 2000, in 2007, 2008, where the top 5 companies actually controlled all of the performance. And 3 to 6 months after hitting that peak, they actually underperformed. But when you look out 12 to 24 months out, you've talked a lot in this broadcast about being investors. I don't think anybody can make 1 quarter or 2 quarter call. If you're investing in the best companies in the world, you're going to win. And I also said, too, Dom, that we're going to see new leadership, right? We're going to see new themes, whether or not that's the mobile society, the mobile worker, working from home, different commercial real estate themes, healthcare, vaccines. Healthcare is a longer-term secular trend. So we are going to see new leaderships. It's not just going to be Amazon and Apple leading forever. We're going to see new leadership and new innovation. And don't forget, too, a major theme we think going forward is going to be onshoring and repatriation. No one's talking about that. So I think that's going to benefit ultimately small and mid-cap stocks. And oh, by the way, financials. We think financials are the #1 contrarian trade right now. Still, we talk about value and talk about dividend growth and talk about dividends still that are being paid. We think U.S. financials, especially the big banks, are a great place to be.
Josh, I know you want to get on this discussion here as well.
Yeah. So first, congratulations, Brian, on your call. I hope it continues to work out, not just for you, but for the benefit of everyone living in America and in need of this recovery to continue. I think the bearish side of every issue typically sounds more intellectual. It's much easier to sound smart when you're detailing all of the ways that things can go wrong and how the Fed is just made the worst move it ever made. And I'm not saying that case can't ever play out, and we've seen instances where it has. Why is it so hard to be bullish and sound smart? You're someone that does it well, but why does the bull case always sound so dopey? And why is it so difficult for investors who've just experienced a huge drawdown to think the way that you do? You're doing this a long time. I'd love your take on that conundrum.
I think it's a great point, and I learned the business 30 years ago from Bill O'Neill, and he told me just stick with stocks, Brian, and if you pick stocks from the bottoms up, it'll all take care of itself. And I think the biggest problem, quite frankly, Josh, is that so many people in our business have really looked at macro factors and quantitative factors, and we've seen those factors, especially the last 2 or 3 years, massively underperform. And the reason why, by the way, the investment community has focused so much on macro is we're so afraid to be wrong. We don't want to be right. So we want to absolutely prove everything that we buy. That's not investing. That's not life. You have to take a little risk. Every time you buy a stock or a bond, let alone walk out of your apartment onto the street, you're taking risk. And that's exactly correlated with what's happening in the world right now. We don't want to take a risk. We don't want to live our lives. We have to start living again. And with that risk will come some reward. Yes, clearly there's some intangibles there, but we have to live. And the essence of investing is taking risk and living.
All right, so Steve, I want to bring you in on this discussion as well, because we've talked about a number of themes, and there are reasons that you are kind of looking towards what Brian is saying with a little bit of perhaps interest, I guess.
Yeah, so here's what I'd say to Brian Osteen's comments. Only kidding, Brian. I appreciate the optimism, and I'm there with you. But in terms of the premise of all this, that you've got such a narrow number of stocks, and we know all the names that have led and going to lead the market, and that's where the performance been. That's just patently false. It's a great headline to say, but I can give you names just this week, last week, over the last few years that performed pretty well. Now, those are the names, if you're going to be a single stock investor and you can't do the bottoms up work, by all means, own them. I own just about every one that's up there, and I own it in size. But you take a look at some other stocks. Skyworks, I've mentioned repeatedly. Great numbers, guided higher. That gave you more performance than the others gave you because they're in the right place. Fundamentally, they're moving quite well. So, I want to disagree with Brian on a couple things. Number one, I don't recall anybody ever saying, I'm never buying technology stocks after 2000. I recall him saying, I'll never buy a .com again. And that was right to do at that point, except for Amazon, which had its problems. So everything Brian says, everything Josh says, everything I said initially, Michael, et cetera, it's great. It makes you think. But to me, what I say when I'm talking about the market is noise. What's not noise is when you get under the hood of a company and you say, I want to own this or I don't want to own it. That's really where the conversation should be.
So, all right. So those are some big thoughts out there as well. I also want to address a couple of things here with regard to how we position with regard to sectors and stocks, because there are places that are outperforming, and we want to know if those trends exist. And, Brian, I'd like to know what exactly you think is going to be that leadership. Which sectors, what types of stocks are going to be the ones that actually should be the ones you add money to, even with the S&P up 30% in just the last month and a half?
Well, I think Mr. Farr said it best. I mean, the way that we manage money, and we have the great fortune of running 5 portfolios in Canada and 2 in the United States, and we normally rebalance our portfolio on a quarterly basis. And I think that's kind of what you want to do right now in terms of trying to be too cute. Drive me crazy, and all these people trying to be cute and say we're gonna buy the market lower. No, there's been nothing cute about this entire coronavirus. So stop trying to make these cute calls. Just own these companies longer term and rebalance. But I think from a leadership perspective, you have to start and stop with technology because it's got this spider web into things like energy and industrials and healthcare. It'll benefit those sectors. But from a broader area, you want to play themes. Themes in consumer discretionary is lifestyle. In communication services, it's the mobile society, whether or not you're streaming or now working at home. We need increased broadband. These themes, by the way, were in place in our work well before COVID, and of course they accelerated during COVID, and they're going to become more important during and post-COVID. And I think the last thing, too, is that I think there's a really interesting theme developing in REITs with respect to how REITs are transitioning some of these properties into data centers or tech centers or distribution centers, or if they have the capital, they're moving them more into residential centers. I think that's an interesting theme, especially given the fact that these REITs are providing some investors with the necessary yield that they're not getting from bonds. So I think that now, but ultimately the true test, by the way, of the broadening out of the market, quite frankly, is going to only happen once investors start feeling more comfortable with the actual numbers in first and second quarter. So come in the late summer, in the early fall, when we start to see a longer-term period, several week, if even month period of broadening out of the market, that'll be the true test of some of these leaders if they can hold on to these massive gains.
All right, so from a sector perspective, I mean,